But anyways, thanks for the introduction, Nancy. One of the things she didn't mention is that I'm also a licensed real estate broker, but I don't broadcast it around. Two, that I was a former member of here, so I know many of you, or many of you know me. But my days are not But my days are not in real estate. Actually, I'm working with primarily real estate investors. But just to add a little bit more about my background, some of you know me pretty much as an attorney, and I do quite a bit of living trust. But in the last few years, I started to lose count of how many months or how many years have gone by. But I've gone back to the CPA world, all because one, there's the age of good CPAs has gotten older. The population's gotten older. And the staff that are joining the CPA firms are relatively young, under 30 years old. So there's a gap between 30 and 70. Many of the CPA practitioners who are established are either close to 80 years old, 90 years old, and people say, why are they still practicing? Well, the truth is, a good CPA never retired. They're always working. The only way they would leave if they are carried out in a structure. I've known many partners who I've worked for. That's all I hear about. They're working until I see their names and pictures in the obituary column. So that's my fate. That's my fate. I keep complaining I'm going to retire. All these young folks that are running around are just wearing me out. And you know, they're full of energy. Two, they have lack of experience, so they don't know really what they're doing. And their main excuse to me is, well, I see it done last year, so therefore I must do it again this year. And I said, wait a minute, you went to college, you learned to be a professional, and you don't question what's done? If I were a client, I'll be scared, because one, what if there's a mistake in there? Their response is, what a mistake. My partner never makes mistakes. And I remember hearing one of the famous quotes says that we're humans. We're not perfect. We make mistakes. So when somebody says, oh, the person I work for never makes mistakes, I start to shake. Anyways, just to also bring you up a little bit, some of you asked me, well, what's the difference between ultra high net worth and people who are high net worth? And my response is, well, the people that are high net worth have few more zeros less than those who are ultra high net worth. I had the privilege of working with multiple billionaires, and the funny thing about them is they're no different than you and I, except that their net worth on a piece of paper has several zeros more than my net worth. And I always thought that, shoot, once I paid off my mortgage, that I'm sitting pretty well, but I guess not. There's some people that, for them a mortgage is what? And the funny thing is, when you tell them, oh, this is the taxes you owe. Oh, how much is it? Oh, you owe a couple of $100,000. Oh, that's nothing. That's petty cash. I wish I had that petty cash in my wallet. A couple of $100,000. Anyways, I'm glad to be here. I hope that you're having a wonderful morning. One of the things that strike me is that I don't know how many of you have noticed in the headlines in the press about real estate and the change in the dynamics of the buyers or the investors in real estate. Is anybody buying real estate a local person, a U.S. person? No. What kind of persons are these individuals that are buying real estate? Overseas. Why is that? Why do you think that they're coming here to invest in our precious real estate? Safety's one of them. What's another thing?
Return.
The price, the return on their investments.
And they're from the country they're coming.
And it's much more predictable.
And they can immigrate.
You know, that is interesting that you brought up the word immigrate. And which brings me to the topic of the day is that what do we do with the foreign investors? And what do we tell these individuals? Because many of you have been brought up in real estate and have learned that, hey, investing in real estate not only has good economic benefits, but also for another reason. And what reason is that? Why do we invest in real estate if it's not for economic? It's for the tax benefits, right?
Right.
Well, I'm going to put that up into the air for possible debate. Because the question is, what do the foreign investors see in real estate? It can't be taxes. Because if you think about it, the tax rate in Asian countries is harboring around 15%, more or less. Especially for those who report the tax. I can't say what it is for those who don't report the tax. Okay? But it's an eye-opener when you come here to find out what our tax rate happens to be. And lo and behold, they also find out that they get another bill. And you can't believe what that other bill is.
Property.
Property taxes. That's a foreign concept unto itself. Why do I have to pay the local government? I never had to pay taxes to anybody. I don't have to report my income. Why do I have to pay this? Is there any way out of it? Yeah, don't own it.
Don't buy it.
But I'm not here to talk about real estate, the property taxes. But what I am going to talk about is a couple of areas that are very important and something that most of you understand that for citizens, we're subject to multiple types of taxes. And the taxes that we have is 1, income taxes, 2, estate taxes. Well, foreign persons have a different concept with taxes. And I want to kind of bring to your attention and kind of educate you as to the differences between residents and non-residents and the issues that they present. Because when you talk to individuals, usually the information you give to your clients is mostly based on resident taxation. But when you're dealing with persons whose status in the country is questionable, the tax consequences may not be the same as residents. Now, let me ask this question. Does it make a difference if you're a resident or a non-resident in the U.S.?
Yes.
And what difference do you think might that be? What distinguishes between a resident and a non-resident? Other than the way they look, well, that's impossible because we're all starting to look alike.
Taxation.
Taxation. Well, yes, the question is taxation, but how do we know how they're going to be taxed? Does anyone have an understanding?
183 days a year.
183 days, domicile.
And then it goes down to an average after 3 years.
I'm sorry?
It's 183 days the first year, but when you get to the third year, then there's income averaging.
Income averaging. Okay. Well, let's start out with the basic fundamentals. Okay? Everybody who's here physically, the question is, are you a resident or a citizen? But basically, there is no difference between a resident and a citizen because the tax rules are the same, regardless of whether you're a citizen or resident. You have to file your taxes on a worldwide basis if you are a resident or citizen. The other concept that's brought up is domicile. Domicile is a technical term, but it's a little bit more nebulous because residence is clear-cut. Either you are or you're not. Domicile is a dream. And let me explain that. Domicile is where you consider your to be your permanent home. If I came to this country from overseas and I said I never intended to remain here because, one, I came here for either to go to school or to work, or I'm just passing through because I stopped in LAX on my way to Europe, or I stop in Newark on my way to Europe. Domicile depends upon your intentions. What are your intentions about permanence? okay? So that's why it's a little nebulous, because the problem is when a person dies, it's hard to ask them, well, did you intend to stay here? You'll be waiting for a long, long time for an answer. So basically, domicile has to do with, it's your intent to remain on a permanent basis. So you could be a temporary person and not be a permanent person. But residence, as someone mentioned, about 180 days, basically the rule is this. If you're from overseas and you're not a citizen here, and if you're legal, well, it also includes illegals, that if you stay more than 180 days, you're considered a resident for tax purposes, which means that you file like all the rest of us, file a tax return and report your income on a worldwide basis. Citizens, there is no difference. You're going to pay taxes because you're a citizen. Okay? Residence is determining whether or not your physical presence here exceeds a certain number of days. Okay? And as I alluded to earlier, why would anybody want to immigrate here? Our taxes are so high. Most of the immigrants probably is better off staying overseas. So many of the clients, especially when I was practicing at Pricewaterhouse and now with Temo, Arjani in Pasadena, is that many of our clients are overseas individuals. They come to consult with us whether or not to, number one, to invest in the U.S., what are the tax ramifications for them, and two, whether it makes sense for them to immigrate. And a lot of times the discussions are not on taxes. The discussion is what is it that they're looking to do on a more permanent basis. Because if it's for tax reasons, a lot of them wouldn't come. A lot of them wouldn't come. Because number one, why would I give up paying 15% tax and come here and pay the multiple layers of taxes we have? You know, whether it's income taxes up to almost 40% in taxes, California over 13% in taxes. You know, and then of course there's choices. You know, most of us would probably say, well, we love to live in California, but Nevada sounds very interesting. Texas sounds even more interesting. The weather is the same as back home. You know, a little bit humid, cheap real estate, that type of thing. California, everything's overpriced, taxes high. You know, why would I want to stay here? So there are many reasons, and it's not economics. But besides, let's leave those reasons off. But let's focus back on taxes. If I have a foreign investor come here, what do I face in taxes that is different than where I come originally from? All I have is income taxes, but the rates are low. There is some inheritance taxes, but it's manageable. But here, the rules are a little bit different. Now, let me ask this question. What taxes do foreigners have to report on? Do they report the same income that we do for their taxes for foreign investors?
These aren't here.
There's a concept. There's two concepts. And I'm going to kind of give you the term so that hopefully if you hear it, you say, wow, I heard that one before. One term is called effectively connected income. And you might ask, what is effectively connected income? Effectively connected income basically is trade or business income. Trade or business. So you think about it. Okay, I come here to do business. I come here to either sell things or to manufacture things. So that's a trade or business. So that's effectively connected. Okay. The other concept is called FDAP. It's an abbreviation. FDAP, I'll tell you what it stands for. It stands for fixed. F stands for fixed. D, not for dogs. D is for determinable. Determinable. The A stands for annual. And the P stands for periodic. So it's fixed, determinable, annual, periodic. That is basically investment income. Interest is one of them. Dividends is one of them. What else could be fixed, determinable, annual, periodic? Rent. They're fixed. They're determinable. They may not be annual, but they're periodic. In other words, monthly. So there's two types of income, trade or business income and investment income. And they're both taxable. Now, which one of these two has a better tax consequences? Which one, if you had a choice, which one would you pick? I'm sorry? One's rental. Anyone else? Interest. Well, interest and rents are the same, okay? That's on the FDAP. I'm sorry?
Dividend?
Dividend, that's on the FDAP. So everybody prefers the FDAP income if you were a foreigner.
The trade or business may have some advantages.
Trade or business income may have some advantages. And that's the key. The difference is this. FDAP income for a foreigner is subject to 30% flat tax.
They
30%.
want jobs. They want great jobs. Great jobs is the name of that game.
For which one now?
For the trade or business.
For trade or business? Well, before we get to the great jobs, I just want to be sure we understand the tax benefits of one versus the other. I'm sorry?
He's into the politics.
He's into the politics. Well, if we have time, we can get into the politics, and you'll find out it's curse on both houses. So anyways, FDAP income is subject to a flat 30%. There's an exception. Of course, the IRS code is full of exceptions. Otherwise, I wouldn't have a job. Because it would be easy, right? You don't need me to figure out 30% of something. Your calculator can tell you that. The exception is if there's a tax treaty. If there's a tax treaty. Because the tax treaty says that FDAP income for citizens of our country get a special break. And that special break is, the tax rate is 15% typically. Okay? 15%. That's the treaty. Somebody asked me once, my client is from Taiwan. Is there a treaty? Is there a treaty between the U.S. and Taiwan?
Yeah.
No, there's no treaties. There is a treaty with China, though. There's a treaty with China. Okay, so now, going back to trade or business, the other flip side. Trade or business are always favored because, the government, they encourage people to come here to start a business. And as always, if it's a business, you're allowed what? Write-offs. Write-offs. Sure, your taxes could be anywhere from 15% all the way to 40 or 50%, but for businesses, you're entitled to write-offs. So if you come to America and make lots of money, but you also have expenses such as hiring people, renting office space, I'm sorry?
Auto expense.
Phone bills, utilities, insurance, auto expense, truck expense, transportation, postage. Oh, not postage expenses, probably very expensive these days. But these are all deductions against trade or business income. So you pay taxes on what? The net profit. So now let me ask you the question, which is better? Trade or business? FDAP.
Depending on what.
Depends on what accounts you have.
Depends on the trade or business.
Trade business is
Why is that?
The quality of the business is going to make you money, and the bad business is you're going to lose money. You don't have to worry about tax write-off.
That's true. But again, most people, when they come here to do business, don't intend to lose money. They intend to make money.
So that quality is important, right?
Quality and the type of business and stuff. And right now, I think they're trying to emphasize many types of businesses. And I think the trend and the emphasis is on manufacturing. Bringing manufacturing back to the U.S. is where they intend to do. So hopefully we'll become a manufacturer. But you know what? It's something interesting. Did you know that the U.S. is now a blank country?
blank.
Well, besides broke. We are now an oil exporting nation. We have never, for a long time, since the 70s, I remember they banned oil companies from shipping oil from the US out. Now they actually allow it. All because we have too much oil. Did you know the oil prices have gone nowhere except stay stuck? With all these prices and everything, all these oil rigs getting blown up and everything else, and the oil price is kind of stable. Because people were predicting when the outbreak in the Middle East, oil would be $200. Boone Pickens was saying oil's going to shoot to the moon. It didn't. And the first time we're allowed to export oil. What is this world coming to? Now it's going to be U.S. joining OPEC? Oh boy, watch out. Anyways, so now we know the difference between FDAP and trade or business. Now let me ask you this other question. Well, let's clarify a little bit about the residency. Not only is it 183 days, but if you also are legal, having a green card, you are also considered a resident. Okay, so that's the definition of residency. Either you have a green card or you were here for 180 days out of the year. Okay, so that means whether you're legal or illegal, you qualified as a resident and pay taxes. Okay, all right. So now we've got some basic definitions cleared away. Let's touch upon one other concept. How many here know what is FIRTA? Foreign investor withholding. Okay, everybody knows what that is. So if you've got a client who is a foreigner, they sell real estate, and there is withholding involved. Okay, and how much is withholding? Does anybody know?
13.3.
How much?
13.3.
Oh my God, that's a lot of money. Now the next question is that refundable?
Yeah.
Yes, it's refundable. It's just a withholding. Okay. Maybe I get so many questions. Is FIRTA, is that a tax where I won't see the money? No, it's just an advance payment because what they want you to do is they want you to file a tax return. They want to see a tax return, and that's why there's a withholding. Because one, they're worried about what?
You not paying money.
They're worried that the money will disappear. It's funny because this government, well, I can't say that. The federal tax system, that's why I say, pooey on both parties, because the tax system says we don't trust foreigners. It's written all over the tax code. We don't trust foreigners. So switching gears. I've touched a little bit on the income tax side, but let me switch to the estate tax side. What are the rules for estate tax?
The person is dead.
I'm sorry?
The person is dead already.
The person is dead, they owe some taxes, and the tax is measured on what? On what?
The 55.
The tax is measured on the value of your assets when you die. Okay? Now, are we entitled to some tax benefits for estate tax purposes? Yes. And what benefit is that?
5 million.
I'm sorry?
5 million.
5 million. Well, right now it's $5,340,000 is exempt from the estate tax. That's a lot of money. I'm sorry?
It's today's value, though.
It's today's value. That's true. That's true. It's today's value. It's indexed for inflation, so it might go up again next year. To what amount, we don't know, but it'd be roughly depending on the inflation rate. So it may increase. And what about this $5 million?
That is per person, no?
I'm sorry?
That is per person.
That's per person. That's per person. So every one of us, we can, don't have to pay estate taxes on the first $5,340,000.
Is a couple a person?
I'm sorry?
Is a couple a person or?
Is a couple a person?
Yes.
Person.
Well, would you have $10 million if you were a couple?
If you were married, you would, yes, you would be entitled to, $5 million for each. And that's $10 million of assets that are
One
exempt.
dies, so then they're back to 5,000.
$5 million. That's true, but there's a way you can save it.
That's a CPA that does that.
I'm sorry?
A CPA that does that, that's what you get paid for.
Well, you don't have to pay me to preserve it, but you would pay a lawyer to do that, though. And that concept, it used to be the old rule that when you die, if you were married, your $5 million, if you didn't use it, would go with you. You would lose it. The only way to preserve it is that by the miracle of the living trust is by using an AB trust, you're able to preserve that $5 million, correct? Well, since they came up with this new rule, they didn't call it Obama rule. Oh. When everything that's they name after Obama, it's just because nobody likes it. But because they like this one, they don't name it after Obama. It's called portability. Portability. Remember that. The new tax concept is that if I should die and I don't use my $5 million, the surviving spouse is able to make an election to take it on to themselves. So the surviving spouse will not only have $5 million, but would take over their late spouse's additional $5 million, so they get $10 million.
Is it portability or potability?
Portability, not potability. Portability. Portability means it's portable. You can take it with you. Okay. So that's important. So now the question is, do we need to have an AB trust?
No.
It's not necessary to have an AB trust to have the benefits of portability, preserving that $5 million. But there are other reasons why you want to have an AB trust. And that's a topic for another day. Because I'm running out of time. So I need to get to the punchline very quick. I need to get to the punchline very quickly. So where I'm going is that, okay, there's another concept. The spouse has the ability to get that $5 million, right? So let's see. Any other concepts we want to make sure that we understand? And the other concept is that, well, if I leave everything to my spouse, I'm entitled to another tax break. And what is that tax break?
Deduct up basis.
That's an additional tax break.
Wow.
There's a lot of tax breaks.
When you die.
Yes, you have to wait till then to get it. But please, don't go out and jump off the Thomas Bridge or whatever it is. It's not that great to do it in order to get the breaks. Anyways, the other benefit, if you are married, you leave everything to your surviving spouse, you get what they call the marital deduction. The marital deduction. And it's unlimited. But there are strings with that. In order to get that benefit, you have to be a citizen. What does that mean? If you're not a citizen, or if you're married to someone who is not a citizen, that individual, any gifts that I make to that person will not be entitled to the marital deduction. It has to be to a citizen. Again, the government was afraid that upon death, that foreign spouse will run back to the home country with the money. So that's why they won't allow it. They have what they call a lock and key. If you want to take advantage of that benefit and the spouse is not a citizen, that person has to agree to lock the money up with a U.S. person, such as a U.S. trust company, to hold the money for them. Because the federal government is afraid that once it's gone, they won't be able to get the money back. Okay? So it's got to be a citizen. Now, let's switch gears. What does a foreigner get? Does a foreigner get the same estate tax benefits that you and I would get?
No.
No. What do they get?
60,000.
60,000. 60,000. That's nothing. It's nothing. Their car is worth $60,000. But if they own real estate, it definitely won't cover it, right? So what does that mean? They're going to pay some taxes, right? Okay, so let's talk about foreigners, what they face when they come here. And a lot of times I joke, I tell people, well, real estate is a bad investment for a foreigner because it's subject to all kinds of strange taxes. And the strange taxes, estate taxes. Because one, they don't understand why they need to pay estate taxes. And the thing is that a foreigner is subject to the estate tax on anything that is physically present in the U.S. Physically present in the U.S. So what that means is that anything that is tangible, physical, that's here in the U.S., a foreigner is going to be paying estate taxes on it. So what do you think? Well, let me switch. So what does that mean? If it's intangible assets, the intangible assets are not subject to estate taxes. Because the law says intangibles are where they live, are permanently domiciled. Okay, so if I'm from Europe, say I'm British, and I own patents, I own stocks and bonds. Those are intangible assets, and the place of residence or permanence is where I live or make my permanent home, which is in England. So those assets, the intangible assets, are not subject to estate taxes. But my real estate that's located here, the cash that's located here, the businesses that I own that are located here, they all would be subject to the estate tax. Okay? So
At unfavorable rates.
I'm sorry?
At unfavorable rates.
Unfavorable rates. The same rates. They're no different. They're same rates as you and I.
Well,
They just get $60,000 deduction.
33%.
So it's 40%.
40%.
40%. Quite high. So that's the dilemma for a foreign individual. So what assets then do foreigners typically invest here? Real estate. And what is subject to estate tax for foreigners? Real estate. Real estate. Is there ways to avoid all this?
Probably yes. That's good.
Are you?
Hire me will not solve the problem. But planning how to own it. Planning on how to own it. Here's the thing. Real estate, is a great investment. And typically what we find, or what we advise our foreign individuals to do, is the use of what we call entities. And you may have heard of these entities. LLCs, corporations. What are they?
Tax dodgers.
Oh, what's the technical term for that?
It would be like a U.S. citizen almost, wouldn't it?
Well, they're referred to as intangibles.
Oh.
Referred to as intangibles. Okay,
The
so
intangible owns the property, and therefore there's no tax penalty.
well, let me finish the story because you're getting ahead of the game. So slow down. Stay with me. Okay, so intangibles. But here's a problem. Remember earlier in the discussion about income taxes, about trade or business? What are U.S. corporations? What are these LLCs? They're trade or business. Okay? They're subject to income taxes. They are subject to income taxes. So the other problem is that the moment you die, these businesses are what? They're located here. So they would be subject to the estate taxes. So we go one step further. We make sure that the business entities are foreign business entities. So there'll be a foreign corporation or some other types of vehicles that are foreign in nature because they're still intangibles. But they can invest in real estate here in the U.S. Or we would create multiple layers. We would have a U.S. corporation that's owned by a foreign corporation, as an example. Not necessarily that's the ideal, but it just depends on the circumstances. So what we do is we create layers of intangibles so that, number one, the foreign investor would not be subject to the estate taxes. But the problem that we face is that if we are successful in one area, we're damned in another area. And the way is we can't avoid the income taxes. The income taxes will be there because, one, it's a trade or business, so they have to pay income taxes. We may be successful to avoid the estate taxes. So there's really no ideal way to avoid both taxes.
But the estate tax is much heavier than the after.
It is a heavy burden, yes, because it's a tax on the value, and you have more control of the income tax because, again, it's on the net income rather than the gross income. So that's where it's controlled. Okay, so now that we've got a clear understanding of the estates and income taxes, what about gifts? I didn't talk about gifts. If we were a residence, what can we do with gifts? The first 14,000 of gifts is exempt. We can give away 14,000 anyone we please. It's not subject to gift tax. 14,000. We can also give away part of our lifetime exemption amount, the $5 million. If we were fortunate enough to have $5 million to give away, we can do that. But can a foreigner do that? Well, first of all, foreigners don't have $5 million. They got 60,000. And the problem is they can't give away the 60,000 while they're alive. It's only available when they're deceased that they can apply the $60,000 credit or deduction.
Hasn't the unified credit gone down on the gift tax?
No, it's the same. It's they unified the credits. It's the same credit. It's the $5,340,000. It's the
We're
same.
going to come up with a foreign national.
Foreign nationals don't have any credits. $60,000 if you call that credit. It's not nothing.
Peanuts.
It is peanuts. So now here's the thing. Foreigners can make gifts of intangibles. Gifts of intangibles, well, first of all, intangibles are not subject to estate taxes. So one, foreigners can make gifts of intangible assets, but not tangible assets. If they make gifts of, say, real estate to their child who's here in the US, they have to pay a gift tax on it. So there's some problems with that. So the benefit for a foreign person is to make gifts of intangible assets versus real estate assets. So, but I want to point out, many of you probably are involved in transactions where the kids who are here, but the parents are overseas, and they're looking to buy real estate here in the kid's name. Have you run across that they need money for a down payment?
Yeah.
And how do they typically get this money as a down payment? Gift money. Gift of which money?
From the business.
Is it a gift of an intangible or a gift of real estate?
Intangible.
I heard that's
we're running out of time, so let me tell you the answer to this question. The problem that we face is that, remember, the government's propensity is that they don't like foreigners. They don't trust foreigners. They don't trust foreigners. So anyways, many of the real estate clients who have children here would buy their first real estate or their first home, as the case may be, and typically the kids would make a purchase and they need money for the down payment. Well, they don't have the money. The money's coming from their parents or some other relatives, and it's a form of a gift. On the surface, it looks like it's just a gift of cash.
But it's not.
But it's not. It's not. In the tax world, it is deemed to be a gift of real estate, subject to gift tax. Yes. It comes as a surprise. I get many questions by individuals. They say, oh, this is what my parents are going to do. They're going to wire me money. I'm going to use it as a down payment for the house, and we're going to mark it down as a gift. There's a court case that came out where the IRS says, no, it's a gift of real estate. And guess what? The IRS won in that case. Because what happened, the court says, is we look to see what was the end result. There was no difference between making the gift of real estate to, you know, the end objective was that there was, you know, it was a gift of real estate subject to the gift tax. So the foreign parents have to pay.
What happens if it's an intangible corporation and their kids are members of that intangible? They've got the money now. That's what you're saying.
That's what I'm saying. So typically, we restructured a gift. We would have the corporation that would own the real estate, and we would gift the corporation. Because the gifting of the intangible is exempt.
So the government really applauds you guys because they give you all these loopholes.
Well, but the problem is that it doesn't solve anything. They still owe some taxes. But it solved the immediate question of, we eliminated one type of tax, which is the gift tax on that. So that's all it does. But they're still subject to the income tax. We can't get away from it, but we try to mitigate as best we can because they're in a difficult situation. The rules are not structured for foreigners very well. As for you and I, we have lobbyists here. Foreigners don't have lobbyists in Washington, D.C. Imagine what their tax laws would be if they were able to have lobbyists in Washington.
It's against the law?
I'm sorry.
It's against the law for them to have lobbyists?
Let's put it this way, no politician wants to be being lobbied by a foreign lobbyist. Let's put it that way.
Okay, Gary.
All right. I'm out of time.
Stay there, you are.
Cheers. Thank you, everyone. I appreciate it, and you guys were fantastic. Thank you.